Welcome to Insights. I'm Eric. I want to share with you an interesting reading that I saw in the Matrix. We'll call this a small cap review if you need to call it something. Down here in the long-term cycles, we can see everything shaded yellow, so everything's clearly dangerous to some degree from the Matrix or the computer's perspective. But when I was looking through the series, and I was kind of thinking in terms of today, hey, there's a big rotation into the small caps because the economy's on the verge of taking off, and perhaps it is. I mean, we could have some type of economic recovery. But when you have that philosophy and there's essentially a buying panic into a sector, and you see numbers like this, and there's another one here in the retail stocks, and that is itself a warning for this group as well, but we'll focus on that later. I think we need to take a closer look at this. So let's pull this up and challenge the idea that there's a massive rotation and you have to buy into the small cap stocks at all. Buy in at any cost at this point. So here we're seeing that those same two, the 1-2 shorter term cycles for the small cap indices, and we're focusing on the dark blue one, which is 3.67. 3.67, there's only 1, 2, 3 periods in which, or 3 points which speculation got and pushed this cycle even higher. Let's zoom in a little bit and take a look. Right here we have the arrows marking these points, and the end result of all this is either a curling action, a quick sharp break, and it's hard to see because this is quite a bit of data. This goes back into the 1920s. So any little break looks like, oh, that's short, but that could be as much as 2 or 3 months. But here this was a more protracted period of consolidation. This was a protracted period of consolidation. And since now we have a box here, even though this box may just be forming, and it could be pushed out, we could have a hard break, we could have sideways action. It's difficult to say. But the point is buying in at all costs is likely a poor strategy to follow. So if we go back into the matrix again, and look, it's the sum of it. The mean cycle for these things is 3. Again, the only one that's higher is the retail stocks, which tells you the dangerous move that's in the retail stocks as well, and I'm sure that they're related to one another. So don't buy this, I'm going to get in at all costs because everything goes up, up, and away. Keep an eye on these long-term cycles. Take a look at them, and anything above 4 or above 3 and into the 4 range close is extremely dangerous. So when you see C1 and C2 get extended, you know that the shorter term, which is 3 to 6 months, is dangerous. These are more longer term, and this puts in tops that will last, probably for multiple years or even greater, but these numbers are not super extended yet. These would have to get into the 3 and 4 as well. So there's more room to go. So maybe the small cap stocks go through a 3 to 6 month correction and then start and make another push higher. Those are different, that's a different conversation to have after you see the pause. Well, first we have to see the pause, and then we can talk about how these numbers change over time. So that's something to keep an eye on. That's it for this little heads up from the long-term cycle section. Don't forget to look down there. So if you have any comments on how to use any of this stuff, you can contact me directly or leave something other than this video. I will post this one more or less in the open section, I believe, so people can take a look at it. I know there's not a lot of interest in the small cap stocks, but the small cap stock sector is very sensitive to the economy. It also employs a huge, vast sector of the U.S. economy. It's important to watch. I watch it really closely. So thanks for watching this review and have a good day.